Good morning, students. So, our next part on journal. First of all, this is the second part of your journal lesson. Over here, we will learn about the modern approach of classifying accounts. First of all, for modern approach, we have 5 headings. These headings are assets, liabilities, expenses, revenue, and capital. Asset and expenses are having debit balance, and liabilities, revenue, capital are having credit balance. Now, what are assets? Anything which gives us benefit, which helps the business to generate cash in the future, is known as asset. That means those investments through which business gets profit. Then, what are these investments? Land and building, plant and machinery, fixture, furniture, goodwill. These are all those assets through which a business can get benefit in the near future. These assets can be tangible, we can touch it mostly, and some are intangible, they also gives us benefit, like goodwill, patents, copyrights, and so on. Now comes expenses. For a day-to-day operation, expenses are needed. Every day we need some help from somebody, and for that we make some expenses. From workers, we get the work and we pay them wages and salaries. From anyone who works for us, we give them commission. As well as rent paid, printing charges, stationery, carriage, freight, conveyance, the list is inexhaustible. These are all expenses which occurs in a year, and the benefit of these expenses the business gets in that particular year only. Then comes, so these two, assets and expenses, are having debit balance. Now we have the credit balances. Liabilities, that is the amount which the enterprise owes either to the outsider or the proprietor, that is liability. When it owes to the proprietor, it is known as internal liability, or simply capital, as this one is. Simply capital, that is internal liability. They are capital when he introduces money, even drawings when the owner takes out the money or stock or asset, whatever. And even reserves, profit, these are all coming under capital. Then comes revenue. These are nothing but the benefit which the business get by getting the cash. It's the inflow of cash takes place through revenue. For this only business is doing business. Sale of goods or service provided by the service industries are the most important revenue generating activities. Beside that, rent received, commission received, interest received, these are all revenues. We will classify our accounts under these 5 headings. These 5 headings. Let's see some classifications. Over here, we have classified into asset. They are cash, cash in hand, bank, that is cash at bank, goodwill, investments, land and building, plant and machinery. Plant means many machinery together. Debtors, bills receivable, furniture and fixture, stock. One thing common is that all of them gives us benefit to the business. Then the next debit item, that is expenses. Purchase is an expense. Students, purchase return is opposite of expense. That will also come under expense. Over here, the expense is reducing because of purchase return. Then is interest paid, depreciation, carriage, wages and salaries, insurance, discount allowed, bad debts, and goes on and on and on. The list is inexhaustible. We have then capital. They are capital, that is whatever the owner has invested as cash or stock or asset. Drawings, whatever the owner has taken out from the business. Reserves, that part of profit which is reinvested in the business. These three together will be termed as net worth, owner's fund, owner's equity, proprietor's fund. That means all the liability towards the owner is capital. Next is liability, that is loans, creditors, bills payable. These are liabilities. Business need to pay this all. Loans need to be paid for a long period of time, creditors, bills payable in a short period of time. Provision for bad debts is also liability. Provision is created to overcome the losses incurred by the debtors. That means those debtors who will not pay the money, for them beforehand only we take out some money from the profit and create provision. A liability is created. Similarly, outstanding expenses, the expenses which still not paid. Income pre-received, that is income which we have received extra, that means not belonging to this year, we might have to return back. Bank overdraft, that means extra money taken out from our current account, we have to return it back. Debentures, company issues debentures, it is a type of loan from the public deposits, etc. Next, see the last accounts, classification of accounts. Under that, the last item is revenue, profit, sales, interest received, rent received, bad debts recovered, discount received, commission received. These are all revenues. Over here, I have written interest received again. We can write over here some other thing received like income received, some other income received, some other income received. So this is also nothing but revenue. Any income which you receive is revenue. These are also going to bring some cash or cash worth into the business, and they are termed as revenue. Now, capital, liability, and revenue have credit balance. Why? Liability means to pay somebody. That's why credit balance. Revenue and capital have credit balance because revenue and capital, whatever the business is earning, as well as whatever the businessman has invested in the business is liable to pay to the business. So again, a liability, though internal liability. So they are again having credit balance. Credit means which the business is there to pay somebody. Next is assets and expenses have debit balance. Let's see what are the method of this debit balance and credit balance. What is this debit and credit? Let's understand that. See, debit, short form is DR, which means debit record, and short form of credit is CR, that is credit record. You know, every transaction has two aspects. One aspect is debit aspect, and the other aspect is credit aspect. Debit, that is DR, stands for debit, which is simply addition to an account. Addition to an account. Debit aspect is receiving or incoming aspect, whereas credit aspect is a subtraction from an account. We have prepared the rent account. Debit aspect will be receiving money, something like that, and credit aspect means reducing money. Credit aspect is giving or outgoing aspect. Next is debit and credit aspects. Debit aspect and credit aspects of a transaction forms the double entry system of our transactions. So now we will be learning the methods of journalizing. You see, we have two methods of journalizing. One is the traditional or British method, and one is this modern method. Under traditional method, we have already divided accounts into real, nominal, and personal, which we have already done. And the debit and credit under golden rules is this. For personal account, debit the receiver, credit the giver. Like when we receive money from Ram. So when we pay money to Ram, so who is Ram? Ram is receiving the money. So Ram is the receiver, so he will be debited. Syam paid money to the business. That means Syam is the giver. So it will be Syam, Syam will be credited. One more aspect in this, cash. In the first instance, when we paid Ram, cash is going away from the business. And that is why cash will be debited, credited. And in the second aspect, when Syam is paying us the money, then we are receiving the money, business is receiving the money. So in that aspect, cash will be debited. Cash is real account. It says debit what comes in and credit what goes out. Similarly, we have nominal account. Nominal account says all loss and expenses debit and all profits and gains and revenues are credit. For example, paid wages. Wages is an expense, so it will be debited. And what is going out? Cash. Cash is going out. That is a real account, so credit. See, we have one real account involved, one nominal account involved. Yeah, one personal account involved, one again real account involved. It is this involvement by which we will be able to understand which account of the transaction we need to debit and which account of the transaction we need to credit. Similarly, we have the other approach which is more scientific than this approach. That is the American approach or modern approach. Before doing that American approach or modern approach, here is one work for you all students. There is a sum which you will be taking a screenshot, and already the accounts are already classified, but you need to do debit and credit by applying the golden rules. Next is the American approach. The American approach says that asset and expenses whenever increases, because they have debit balance, so they will be debited. And whenever they reduce, we have to credit them. For example, we purchased asset, like purchased furniture from Hari in cash. So furniture being an asset is increasing in the business, so furniture account debit. Cash being an asset is reducing from the business, so cash reducing, so it will be credited. So my asset, one asset is debited and one other asset is credited. Furniture was increasing in the business because we purchased furniture, and cash is reducing from the business because we are paying cash. So furniture aspect will be debit aspect, and cash aspect, that is cash transaction, cash part, will be credit. So we will be able to easily distinguish between debit and credit. Similarly, paid wages. Wages being an expense, any expense increase is debit, and any expense increase is debit. And when we pay wages, cash is going out. So that is nothing but what? Cash is going out, so we have cash is going out, so we have cash credit. Next approach is the liability, capital, and revenue. They have a credit balance. Whenever they increases in the business, they will be credited. Increases in the business, they will be credited. And whenever they decrease in the business, they will be debited. For example, when owner has introduced capital, capital being a credit item, whenever increases in the business is credited, and cash is also coming in the business, so cash is debited. You see, capital increased, that's why credit, and cash increased, that's why debit. Similarly, rent received. So rent received is an income, is a revenue. Rent received, it has cash has come in the business, so cash will be debited. And rent, when increase, so it will be credited. Similarly, if it is any liability payable, like wages payable, outstanding wages, see, so easily, outstanding wages Outstanding wages is a liability, increases in the business, will be credited. And it's about wages. Wages is an expense, debit. So one aspect is wages, one aspect is outstanding wages. Wages is debited, outstanding wages is credited. With this understanding, we can easily do the uh, we can easily do the debit and credit under modern approach. Let's do this sum of debit and credit under modern approach. Amit started business with cash. Given cash and capital is the two aspect of this, two transactions involved, two accounts involved. Now when he started the business, cash is what? Cash will be debited because cash has come in the business. Whereas capital will be what? Capital will be credited. Why? Because capital is also increasing. Any liability when increases, credit. Next is purchased goods. Purchased goods means purchase is an expense. Expense has increased, that's why debit. And cash has gone out. If anything go, cash has gone out means cash has reduced from the business. That's why credit. Similarly, purchase goods from J in cash. Purchase is debited because purchase is an expense. That's why debit. And in cash, that means cash has gone out. My asset is reducing. So credit. Again, sold goods to Avi. Sold goods to Avi. No cash transaction is mentioned. So it is nothing but a credit transaction. Credit means the money is not paid. Sale goods means sale is a revenue. So sales is credit. Sale is a revenue. And any revenue is always credited. And to whom? Debtor. Debtor is increasing in the business. That's why debit. Students, if you can mix both the methods, then that also is possible. Avi is the receiver of that goods. That's why debit the receiver. That's under traditional approach. Avi is becoming our debtor. Debtor is an asset. Asset increasing in the business. That's why Avi will be debited, whereas sales was credited. Paid J. J is the receiver. That's why debit. Or J being our creditor, no more remains our creditor. We are paying him. When creditor reduce, we are debiting. Either you use he is the receiver debit or creditor reduce. That's why credit. That's why debit. Cash is going out or cash is reducing. That's why credit. Similarly, received from Abhi, the amount due. We are receiving cash. Cash increasing in the business. Cash is asset. Asset increases in the business will be debit. And Abhi is the giver, so he will be credited. Or Abhi, you can say, is my debtor. He is no more remaining our debtor because he is paying the money to us, so he is credited. Paid wages, so wages will be debited. Paid wages, wages will be debited because it's an expense. Any expense is also always debit. And cash has reduced from the business. That's why credit. Cash has reduced from the business. That's why credit. Next is received rent. Cash and rent. Excuse me, student. Received rent. Cash has increased in the business. That's why credit. That's why debit. And rent. Rent we have received. That's why credit. Rent is a revenue. Revenue is credited. Sold goods in cash. Sales is an income. That's why it will be credited, and cash is coming in the business. That's why debit. Deposited cash into bank. Cash is debited and bank is credited. Similarly, due stock from business. Due stock from business. Drawings is debit and stock is credited. Due stock from business means capital has reduced from the business. Capital reduced means debit, and stock is going out of the business. That's why credit. Similarly, bought furniture. Furniture is an asset increasing in the business. That's why debit. And cash is reducing from the business. That means asset again reducing. That's why credit. That's all, students. You will be doing this sum again. You will be redoing this sum again. Same sum under this modern approach. And then
We will be understanding what is journal in our next video. Thank you, student.